And welcome back to another coach's mailbag question. Coach T, tackletrading.com. This one comes from KL. And, I met KL out in Malaysia actually last year in 2017 when I was traveling out there teaching a class. And KL has a question about a covered call on Apple and built some details into Apple and, talks about buying 100 shares, selling the right call option, what the cost basis is, what the break even is. The question comes in here that I place my trade buying 100 shares and sell -1, but somehow to buy back the 100 shares, if the stock is not heading bullish or neutral, it goes bearish. And let's think about that, KL. You might have some confusion on a few different data points, and let me bring up a couple of different things. Number one, you have entry, and then you have exit, right? So when you build a covered call, let's just kind of clarify a couple things. You buy 100 shares of stock, and then you sell one call option, which is a contract. Now, we're not going to teach what a covered call is or what the philosophy is or what options are. That's for courses and for the, the shows and everything at Tackle Trading. Let me just kind of clarify the management of it. These are independent positions. I mean, we tie them together because we think of them together, but they are independent positions. 100 shares of stock on its own is bullish, okay? And I'll just draw an arrow here. It's bullish. A call option on its own is bearish, but together, when you combine them, oh, and I am really becoming an artist here today, guys. Hopefully you can get a chuckle out of it. It's slightly bullish. Why? Well, because the call option is not as sensitive or as important or as big as the stock. So the stock kind of is the big brother. The call option is the little brother. And so it's slightly bullish because of the nature of the trade. You can even find this inside, your Analyze tab when you build a covered call. Let me bring up Apple Computer here. So if I simulate a covered call and I buy 100 shares of stock by locating the underlying for the stock option, or for the stock I should say, the risk profile shows me a bullish line, okay? Which means that if it goes up in price, I make money, profit here. You see this number is going positive, and if it goes down in price, I lose money. When I follow my rules for my call options, and by the way, if you're out there and you're like, well, what are the rules for the call options? Go and get the Tackle Theta Research spreadsheet on-site Tackle Trading. If you go to tackletrading.com, find the Trade Center, and then in the menu on the left, there will be the journals, okay? And then you can find this. Rules for the covered calls are down here, okay? It shows you the theory, the bias, the strategy, the rule for delta, theta, vega, position sizing, stop loss, some different things. And by the way, there's a bunch of videos on covered calls that we have even on our YouTube channel, so you can check that out. If I then go and follow my rules using the 28-day option, the 37 delta, I sell this. I then have this construction here together. Now, for one covered call, I only need one call option for every 100 shares. Look at the risk profile, and it will show me a position. Now, you'll notice it's not as aggressively bullish up here because that pink line kind of turns over. Without the call option, I can make more money if it goes up. With the call option, I lower my break-even point. I lower my cost on the trade. I create a cash flow situation through the positive theta, but I don't make as much money if it does go up in price. So that's kind of the trade-off of the covered call. Now, back to the question. If you buy back, and I think what you meant by that is sell the 100 shares because you bought the 100 shares originally. So if you sell the 100 shares on their own, the trade will go bearish, because if you think about this, and bring this graph back up, if you just get out of the 100 shares, now you just have a naked call option, and so you will be in a short contract position, whereas it would want to go down in price. And so you're flipping and changing the trade if you did that. What I recommend, KL, definitely learn your covered call management. Obviously, when you're building a trade, now I'll give you a couple of real good things here. Great job building the trade. You followed your rules for delta. You followed your, understanding of what the cost and the break-even points were and the risk and the reward. You measured the ROI correctly. Your management, you have some gap in the understanding there, and I think that you just got to practice a bunch, obviously. Perfect those rules, perfect those understandings, and learn how to execute the covered call. Because when you are exiting the covered call, you have a couple of different choices. You can either exit the call option independently, and you would buy the call on its own, or if you ever want to get out of the entire covered call, then what you have to do is you have to sell minus 100 shares and buy +1 call at the same time. And there's an order entry that you can do to do them as a combination trade. So either you're going to do the call option on its own, or you're going to get rid of both of them at the same time. Rarely should a trader sell off the shares and keep the short naked call. That would be a very advanced position, and you would have to know why and how you're doing that. Probably not where you're at right now, as a new trader. So good question, KL. I love seeing you trade covered calls. They're a fantastic strategy. Keep it up. And hopefully we gave you a little bit of clarity on how that works.